Cool. Good morning to everyone who's joined so far. I can see quite a few familiar faces in there, and it is nice to have you along on a Friday morning. Now, the topic of today's webinar is quite an interesting one, and I almost didn't do it, but at the same time, the interest has sort of blown me away. It's one of the most complex topics that we cover with our clients at Inspire, but I feel like it's a little bit of a nerdy one. But anyway, it's something that is often, it's often confusing. And what I'm looking forward to today is actually going through and running you through some solutions for company loans and Division 7A. So thank you for everyone who's joined in this morning. So hopefully I'm going to be able to shed some light on this for you as we go through. Now, as usual with our webinars, I usually share at the start the webinars we have coming up in the future, and the links will be in the chat box in a moment. And while I run through these, I just want to throw up a poll. Where are you joining in from this morning? Friday morning, talking about tax and accounting. Cool, thank you. I can see a few answers right now, but okay, so the next webinars we've got coming up, we've got Basics of Business Structures, which is Wednesday, the 29th of September. We'll be going through the differences, sort of the key differences between companies and trusts and sole traders and why you'd pick one over the other. And again, a really sort of a 101 level. So if you do want a little bit more knowledge on the basics of business structures and how they work, please join in on that one. The link should be in the chat box in just a moment to register for that. Also, another one we've got coming up is Wealth for Life. So this is actually, instead of more like a webinar, this one's a workshop where it's a couple of hours long, and we've got a workbook we work through together, but the focus here is on personal finance. So making sure you get those organized and implement strategies to be able to build your wealth. Now, we've also got one coming up which has been a popular topic, which is all about self-managed super funds. That one's on the 20th of October. So October is going to be a big month for this stuff. But the topic here is becoming an SMSF millionaire. So we have a lot of clients with self-managed super funds, and again, they're so powerful if you know how to use them. So we're going to be sharing, our sort of start to finish. We'll actually do a series on self-managed super. So this will be the start of it, where we'll share a bit of an overview, and then we'll go deep dive into particular topics. So again, the link is in the chat box to register for that one. All righty. Now, I do have a bit of an introduction to me for those who don't know who I am. My name is Ben Walker, and up on the screen now is pictures of my family. That's my wife, Stevie, and my two kids on the right, Rose and Ezra. So they're 2.5 years old and 8 months at the moment. So yeah, love them to bits. In terms of me, I started Inspire about 9 years ago now. When I was 23 years old, a little bit disheartened with the accounting industry, and again, the whole focus for us is to create a better, or as best we can, the best client outcome we can. So no timesheets, use of technology, and things like Xero and making it seamless, ideally, for an online experience. 13 years accounting experience. That seems like heaps now. But and then a couple of years ago, I also co-authored a book called Cashed Up. In terms of Inspire as a business, we've helped our clients save over $17 million in tax and counting, which is, I was reflecting on this yesterday. That is a massive number and a huge amount of wealth that has been retained rather than tax paid in our client base. And the cool thing about our tax saving number is through our Day for a Dollar campaign, we've actually given a day's worth of access to food, water, health, and sanitation to a family in need. So 17 million days of access for through our partnership with B1G1. I think there's a few members of that one online, which is pretty cool. I usually do this at the end in terms of offer help. In our webinar, we've got current clients who've joined. And I do want to suggest, if you've got questions or want to clarify anything that we've spoken about today on the webinar, please book a Zoom with your Inspire accountant. We can do a Division 7A review. There's no cost to do that. Again, the purpose of that is just to answer any questions, debrief, and look at how that applies to your own structure here. If you are keen to explore working with us, the option for you is to do a look under the hood with us. Now, a look under the hood is a second opinion on your tax, and we do an analysis. If you were working with us, could we have saved you any tax? And we review your most recent financial years, financials and tax returns that your accountant has done, to make sure they've implemented every strategy they can. Otherwise, we walk through with a list of things that we've picked up there. Now, that does include a Division 7A review, so we do have a look at that stuff if you are struggling with this. And the way I kind of put it out there, I think in the email even, is like, if you don't know what company loans are or the word Division 7A, then this webinar or this topic wouldn't have interested you. We wouldn't even know what it was about. But if those words are triggering you, again, whether you're a current client or considering, or you are with another accountant, then this stuff, if it is frustrating to you, again, we just want to be able to work out a more medium or long-term solution for you to deal with this stuff. So, there's some options depending on who you are when you're joining today. In terms of a strategy call, for those who aren't working with us, we can usually do them. I mean, I think we're booked up early next week, but for the next couple of days, but usually within the week, you can book in with someone to do a strategy call, and the link is coming in the chat box in a moment. But that's a bit of a next steps if you are keen for any additional help after the webinar. But here's what we're going to cover. So we're going to cover the basics of taking money out of a company, but also a trust. I just want to show you the distinction between the two structures, because I think we'll have people who have joined with a variety of different business structures. So I kind of want to cover the basics, and that's sort of topic one. I'm going to cover why Division 7A exists, so why the legislation has been brought in. Again, it may make a bit more sense if I share the why behind it, whether we agree with it or not. But no, I actually don't think I think it's actually fairly reasonable. And the goal there is what we need to work out is what are the short, medium, and long-term solutions. So, again, at Inspire, our philosophy is like, it's okay to have these loans as long as they're managed. So we just need to make sure they're managed well. Also, we advise clients on different strategies at different incomes, wealth positions, cash positions, goals, stage of life. So a suggestion we might make to one client might be completely different to a suggestion we make to another client, and it kind of changes as the client grows, how we manage these things. So that is important to know. So if I share these solutions, it's not like go out and implement every single one of them. It's important that you make sure you implement the most appropriate one for you at the time. Cool. All right. Well, we're going to cover the basics of taking money out of a company versus a trust. Now, I think on the screen you can see my little pointery thing here. Also, I have got my chat box and Q&A panel open. So if you do have questions about this stuff, then please feel free to pop questions in either. I'll keep an eye on it. And let's go. So in terms of taking money out of a company versus a trust, we'll start with the first way to take money out of a company, which is a salary. And I think some of you who've seen a webinar or two or a workshop before may already know this stuff. I'm just going to cover it briefly again. So we take a salary out. Now, that's to pay ourselves or our spouse, let's say, if they work in the business. Now, even if it's paying ourselves, we have to take pay-as-you-go withholding. There's a requirement there. And we also have to pay super, which is currently 10% at the moment. It went up from 9.5% from 30 June, 1st of July. Just changed over a couple of months ago to 10%. Now, that we basically treat ourselves like we would an employee or a team member. So it's a pretty easy one to kind of wrap our heads around. Now, in terms of taking money out of a trust, the first way to do that is also to pay a salary. Now, if you are, if you do have a trust structure as your business structure, you may not be taking a salary, which is completely normal. You may be looking at these other two options here. Now, if we switch around to, and I'm just going to switch my screen around a touch. Cool. So the second way to take money out of a company. And when I say take money out, this is like cash sitting in the company's bank account. Again, option one, pay a salary. Option two is to loan it out of the company. Now, Division 7A in brackets there is the rules that surround loans from companies, and that's the whole topic of the webinar today. So this is going to cover if you have taken money out as a loan. Again, we use them all the time, so it's completely normal. But if you've got it there, if you're struggling with it or it's confusing, the whole purpose of this webinar is to go through that stuff. But again, that is option two, to take money out. If we compare that to trusts, you can take a loan out from a trust. We call that drawings. It's got a slightly different name, we call it. And there's no requirement. So Division 7A, in summary, says you've got to repay the money from a company. You can't just endlessly rip it out. You've got to repay it with interest and minimum repayments and a maximum term. So I'll cover that in a bit more detail. But if we go to a trust, the loans from trusts don't actually have those requirements. So there's no requirement to pay that money back to a trust. Now, it sounds better, but again, different client groups, different situations have different structures in place. And again, it neither is better than the other on a global level, so to speak. But it just depends on your family situation, which one of these is more appropriate for you. Now, out of a company, the third option is to pay dividends. Now, dividends are paid to the shareholders of the company. So when we set up a company, we need to be very conscious of who actually owns the physical shares in those in that company, because they will be receiving the dividends from it and be taxed on that. So often, if we are setting up your structure, we'll want a trust to own those shares. And the whole idea of a trust is because we can choose from that point onwards who actually gets the dividend at the end of the day. So that's the whole idea of a trust owning the shares. And in brackets there, I've got a dividend is a payment of prior year profits. So ordinarily, you'll earn a profit. Let's say you earn 100 grand in profit, you pay 26% tax. So you're left with 74 grand in after-tax profit in the company. And you can pay out of what we call a franked dividend after you've paid that tax. So it's usually the next financial year. Cool. Now, again, comparing it to the third way to take money out of a trust pays a distribution. Now, that is every single financial year. So in brackets there, we've got current year profits. So if a trust makes $100,000 in profit, we need to distribute that in that financial year, and it hasn't been taxed yet. So it will give its profit to family members, your spouse, your kids, potentially your parents, retired parents. There's a whole list of people we can consider there. Or it can give it to other entities in the family group. Now, sometimes we distribute profit from a trust to a company, and that's going to be important later when we talk about how these Division 7A things arise. Also, just keeping an eye on the questions. Susan's asked there, please define the term franked dividend. So I gave an example before in the company where you earn $100,000 in profit, you pay your 26% tax. Now you've got 74 grand in the bank account. So you can pay a dividend, and because you've already paid tax on that 74 grand, you can attach that $26,000 tax as a credit. And we call that a franking credit to the dividend, so that your shareholder isn't taxed on the full amount again. So again, in the shareholder's hands, they're not paying tax on the $100,000 without any credit. The company's already paid the tax on of the $26,000. So I hope that it is a complex, what do you call it? Yeah, it's not an easy thing to kind of understand, but it's basically preventing you paying tax twice on the on the profit. All righty. Now, that is the basics of taking money out. The next one here is why Division 7A was brought in. So I'm going to up the figures here. Just bigger numbers makes it a little bit more, I think, easier to understand. But let's say you made $100 million profit. Now, if you were a sole trader, whoops, there's a 4 missing from this tax rate. So option 1 is taxed in your own name at 47% top tax rate. So 47% is the highest marginal tax rate of an individual. Now that is actually higher if they have a HEX debt. There'll be another 8 to 10%. I can't recall. So you're above half of your profit going to the tax man. And then more again if you don't have private health insurance. So, but let's for argument's sake, let's say 47% tax is option 1, which means on $1 million you're left with $530,000 in after-tax profit. Option 2, if you earn that $1 million profit in a company and you meet the requirements for the reduced company tax rate of 26%. It's a flat rate of tax, so it's not marginal, and you're looking at net after-tax profit of $740,000. So you can see it's a considerable difference, and whether, a way to look at it is whether that $1 million was earned in a single year or over a couple of years. The point is, in a company, you end up with a lot more after-tax money, but the whole idea of Division 7A is for most people, what use is cash in a company? We want to get that out and spend it. And so the 2 examples I've given for years, and I pick on Clive Palmer, but Clive wants to buy a bigger boat. It wasn't him that Division 7A arose, but I use him as an example. Bit of an easy target. So he wants to buy a bigger boat. He can buy a bigger one basically with if he funnels the $1 million in profit through a company versus his own name. Funnel's probably a poor choice of words, but you get the idea. Is he's got more net cash if he structures as a company versus taking it out in his own name. So that's example 1. So what he would do in this case is he buys a boat in a company name. Now, that is still a Division 7A issue if the asset he buys is a personal asset. So like a boat, for instance, if it's got nothing to do with his business, then he has Division 7A consequences on his boat, even if it is in the company name. So he doesn't need to even take them. Like the second option here is where he actually takes the cash out of the company into his own name and buys a house. So he buys another Gold Coast mansion, which he's actually just done to live in. So instead of paying tax on the profit in his own name, the company pays less tax and then it loans him the net profit. So still put it through the company, but instead of paying it out as a salary or a dividend, we loan it out so we don't pay that extra tax. So that's the whole idea. And so why Division 7A was brought in was to stop that. And basically it's a way of taxing that money that's loaned out or personal assets that are bought in the company's name. All righty. Paul, I may address your question there towards the end, if that's all good. Cool. All right, so that's the why. And I guess, everyone joining on here, I don't think Clive Palmer is going to be joining on the call today, but what I do want to say is, where does the money go? So often when we're advising clients, these loans on the balance sheet can actually be quite confusing, and almost the question that pops up is, how did that even happen? So here is a potential list of answers for that. So let's say your company earns $400,000, and for tax purposes, we pay you and your spouse maybe 120 grand each for salary, dividends, whatever. And then with the extra cash in the company bank account after that sort of 240 grand, you actually loan that money out and do a number of things with it, whether you use it for living expenses, or you put the extra cash on and pay down the mortgage, or put it on the offset account. We've had a lot of clients buy property over the last couple of years. Good timing, especially with the market how it is. And again, that cash for the deposit's got to come from somewhere. Other investments that you purchased, or even lifestyle expenses. So travel, toys, boats, even like that's a a potential answer for where the money goes. So, so these loans arise basically because more money has come out of a company structure than you've been taxed on personally. If there was one way to sum up Division 7A, more money has come out of a company than you've been taxed on personally. So there's a potential list of answers. Also, if you pay yourself $120,000 salary, you do have tax out of that as well. So net cash in your own hand may only be about, ballpark, 90 grand or so. Again, it can be tied up in tax there. So I hope that kind of clarifies how these things might exist. But yeah, the short answer is there's more money come out of the company than you've been taxed on. So what are the rules around Division 7A? So it was introduced in 1997. So it applies to loans after that. When I started in accounting, we had a couple of clients who had loans pre-1997, and they basically didn't repay a cent of them, and they probably haven't. Because there's no requirements to abide by these sort of rules from that point previously. But in general, the loans need to be documented. There's principal and interest repayments required, maximum term and minimum repayments calculated per a formula. The interest rate each year is advised by the ATO. Currently, it's at 4.52. It's usually a few percent higher than you can get a home loan rate from, and it has gone down over. I guess it's continually gone down since I've been working in accounting. So is the interest rate. Now, if the loan is unsecured, you've got 7 years to pay that back, and if the loan is secured, you've got 25 years to pay it back. And that is a little bit of a hint on one of our medium to long-term solutions for Division 7A loans. It also applies to distributions from trusts. So if you've made that, let's say the $100,000 in a trust, and you pay a portion of that to a bucket company, and you distribute, and we do that often to, manage a family's tax bill. You've actually got to pay the cash to the bucket company. Otherwise, you create a Division 7A loan. Again, it's not necessarily the worst thing in the world. We've just got to manage it. And again, the next slide is, and onwards, is those ways we can do that. So short-term solutions, and yeah, kind of one that we don't want to use for long. But one of the short-term solutions is a lot of clients put their excess cash in their offset account to reduce the interest on their home loan. And before 30 June, they go and repay that loan. Now, that is a repayment of the Division 7A loan. But technically, if you just rip it back out on the 1st of July, the ATO's got the ability to look through that. So we don't just want to be blatant about putting it in, ticking over 30 June and ripping it back out again. We do need a better, more medium to long-term solution than that. So that and again, that is very common. We see that all the time, but again, we don't want to. That's not our only trick, so to speak. That's a weird way to put it. That is kind of no way to manage it long term. Just jumping back here, Vix asked a question: does it apply if a trust loans money to another trust? No, it doesn't. So again, if there's no companies involved anywhere in these loans, then Division 7A does not apply. Also, if a company lends to another company that you own as well, that does not attract Division 7A because company to company is excluded. And if we think back to why these rules were brought in, because if the money is being lent from one company to another, the company still has the cash. It hasn't moved into personal hands or to purchase personal assets, which is where we get stuck with Division 7A. Cool. All right, jumping back to this one. Susan's asked, please define offset account. Does an offset account only exist for a home loan? Yeah, an offset account is a some of the banks offer it with a mortgage. And basically, if you put, let's say you put $10,000 in your offset account, that will offset a portion of the interest up to the interest of 10 grand on your mortgage. So yeah, that's a bit of a mortgage brokery question, but that's the idea of an offset account, is it offsets interest on your home loan, and calculated it every day that your money's sitting in that offset account. In terms of medium-term solutions, so these are better. Here we go. Now, a very common one we do is just pay the minimum repayments on the unsecured loan. So again, if we think back, unsecured Division 7A loan is a 7-year term. There's minimum repayments. We can pay these in cash, so actually transfer back, or the alternative in terms of paying them back is to issue dividends to the shareholders or pay salaries to the people running the business on paper only. Instead of paying them cash, it reduces the loan outstanding. So basically, let's say there's a $10,000 minimum repayment needed. We can issue a $10,000 salary, and instead of transferring cash from the company to the personal account, we can just reduce that off the loan that person owes back to the company. So that's one of the medium-term solutions. The next one is cascading loans. So if you're taking more cash out each year, we can start a new loan in that financial year that you take more cash out of the company. So the whole idea of why we would do that is basically it resets your 7-year repayment term. So some of you on your balance sheets may have loan dash your name 2020. On the next line, loan dash your name 2021. So again, each financial year may have its own cascading, or each loan may have its own financial year attached if you are drawing down more each year. So it might look weird, but that's the whole reason, because it resets that 7-year term. Build up the loan, knowing you'll pay the dividends to repay minimum repayment or the full loan. So what I mean here is sometimes this is a strategy we use when people are retiring, and we know that, or they're coming up to a business exit. So we'll intentionally tax them less in their own names, build up a bit of a Division 7A loan in their company. And then once they're no longer earning income in the company, we can pay down dividends back to the individuals to reduce that loan outstanding. So, or another way we do it is just leave the money in the company and issue the dividends each year to extract that money once the business is sold or they've become retired. So again, we've got a handful of clients who we've helped through that process with, and some that have sold a business 3, 4, 5 years ago, but each year they get a dividend back and they get a refund of those franking credits we talked about before. So again, that's another one that may help. And again, that's a very specific set of circumstances for a client. Cool. I can see those questions coming in, so I might go to those now. Michelle's asked, does the loan from one trust to another trust change if the bucket company hasn't received cash? So again, there's a company involved in your question there, Michelle. If you distribute to a bucket company from a trust on paper, but you don't pay the cash over, then yes, you will create a Division 7A requirement there. Paul has asked, how much interest rate should the loan charge? And can we fix the rate for 10 years? Okay, so jumping back to this slide on the rules, the ATO advises the rate every year, and it changes every year. So in a way, it's not fixed, it's variable. And the current rate is 4.52%. If you were to Google ATO Division 7A rate, they'll have a table there showing what the interest rates for the last however long have been each financial year. And I think they announce it to, either at the start or just before the next financial year. So we'll know next financial years, maybe in April, May, June next year. All righty. And then in terms of fixing it for 10 years, well, again, we can't fix it. And 10-year term, or 10 or more years, then you would have to have a secured loan on that one. So we can't do an unsecured 10-year Division 7A loan because, again, we've got the maximum of 7 years for that one. Cool. So what are the long-term ones? Long-term solutions, and I've got in brackets on this slide, and permanent solutions as well. So avoiding Division 7A altogether. It is possible. There's potential drawbacks though, because again, we're not getting access to that cash personally, but that may be okay depending on your circumstances. So first one we've got here is actually pay the cash into the company. So just pay the cash back and you're repaying the loan. But the downside or the drawback is this may be a poor use of funds. Now, keep that in mind. That might be step one to combine with one of these other solutions down here. So another option is to pay the top-up tax. It is expensive. So what I mean here is if you've already paid 26% tax in the company name and you want to get access to that cash permanently, then you can issue dividends or salary, depending on your structure, to the individuals in the family group. You may be taxed up to 47% on that, and we call that the top-up tax of 21%. Now, again, we can work that out, what that cost for you is to clear the Division 7A loan account, but it may be an expensive way to do it. And usually, again, there's potentially better solutions to work around that. The next one here is buying shares or managed funds in a bucket company. So I've got the word bucket company here because we wouldn't want to buy shares in a trading entity. The trading entity, because if you're in business, it is attracting risk in your entity. So from a asset protection perspective, we don't want to create an asset to potentially lose if something were to go wrong in the business. But again, we can bolt on a bucket company to one of your structures so that we can take the dividends out of your trading entity, put it in a bucket company, and then buy shares or manage funds in there. So again, there's a way to do it, but we just don't want to buy shares or manage funds in a bucket company. In a trading entity. Also, if you do buy shares or manage funds in a company, you do not get access to the 50% capital gains tax discount if you own those shares or manage funds or assets, anything, property, whatever, for more than 12 months. So in your own name or in a trust's name, you do get that 50% discount, but in a company, you do not. Now, the whole reason why I'm suggesting shares and managed funds and not property, is because shares and managed funds often have an income component to them. And your tax rate on that is 26%, or if it's a purely investment company, you'll be paying 30% tax on your dividends and trust distributions from the managed funds or shares. So in terms of property, there's if you do want to buy property and use company money for that, we might look at option 4 for that. And just jumping back to shares or managed funds, if you've got the choice, then the preference would be to invest in income-focused shares and managed funds in the bucket company. And if you've got capital growth assets, like, again, you can buy, let's take index funds. There's certain index funds that the goal is to produce an income stream. And then there's index funds where the goal is to grow in capital, but not pay anywhere near as much income along the way. Then that is the one, because your priority in that case is a capital gain. We may want to structure that one in a trust instead, so that you're able to access that 50% discount if you were to sell that that index fund or managed fund. So again, the income focused is the priority for the bucket company. Again, we're getting really detailed into there. And this is where a conversation with the accountant would go really well to just work out, look, are we jumping at shadows, splitting it this much, or some people's investment strategies actually require that sort of detailed planning. Alrighty. Number 4, secured loan. So again, if we go back to the loan, so we've got 7 years is a maximum term for an unsecured loan, and that's just taking the money out with a loan agreement. Now, a secured loan, we need a loan agreement. We've got 25 years to repay that, but we do need to have a mortgage on a property. So the company, your own company, becomes like a bank. And it takes a mortgage out over a property. Now that could be your own home even. So the company could lend you 100 grand and have a mortgage on your home. In terms of how that might work, you might already have a mortgage on your home from an actual bank. And they might take a first mortgage where your bucket company takes a second mortgage on your house. Now, there is a mortgage on it, which means you meet the condition of being a secured loan. There are more requirements with that. Again, documentation is key, and there's a certain maximum of loan to value ratio you can go on a property. But again, conversation and get some advice around that. Now that can work for your own home. It can work for investment properties. It can work for stuff owned in trusts, in other entities. There's all sorts of ways that we can take the money out as a secured loan, get a second mortgage on it, and that's a way where, again, we can reduce the burden or the repayment requirements on these loans. Also, keep in mind, if you do borrow from your own bucket company for an investment property purchase, then that interest that the trust or the person pays back to the company is tax deductible to the person if it's used for an investment property. So keep that in mind. If you're borrowing from your bucket company to buy your own home, if your own home is purely to live in and it's not producing income, then we can't claim that interest paid back to your bucket company on your tax. So that's the distinction there. Cool. There's a couple more questions that have come through. That is the meaty part of the content today. So we'll be going into a bit of Q&A in a moment. Again, like, this is a lot of information, and it definitely hinges on your structure, your stage of business, life, all that sort of stuff, where your cash is, your cash requirements each year to live. So again, if you are a current client joining, please book a Zoom call with your accountant if you do want to run through this in a bit more detail on your own structure. If you're keen to work with us, again, I mentioned at the start that the next step is a second opinion, or we call it a look under the hood, a second opinion on if you're paying too much tax, and that includes a Division 7A review. So if you've been having headaches there, we might be able to clear that up with you. That starts with a strategy call, and the link is just been posted in the chat box if you do want to do that. So again, that's the formal part, or my structured content covered. Now it's open to the questions. So Vic has asked, can my bucket company charge the same interest rate as my home loan if I used it for my home loan? No, unfortunately not, Vic. You have to use that ATO benchmark interest rate. There's no way around that one. Liz, if you buy a property in your company name, but subject to Division 7A, does the property actually still belong to the company? Okay, so if you buy a property, let's exclude your own home. If you buy an investment property in a company name, you won't create a Division 7A problem because it's been using the company's money, if that makes sense. So there will be no Division 7A requirements. Again, if you buy your own home in a company, you've got a personal use asset in your company. And from that Clive Palmer example where I said if he buys a boat for personal use in a company, that attracts Division 7A problems. So I don't think we've ever had a suggestion or advice to a client to buy their own home in a company in any case. But again, let's keep that to an investment property, and you don't attract that. And you don't attract Division 7A. When we do a look under the hood call, is that with a chartered accountant within your team or yourself? So it is with an accountant in our team, Abdul, not myself. Cool. Liz. Yes. Does the boat still stay in the company? Yeah. So if you bought the property in a company or the boat in a company name and that doesn't change, then it will be the company's assets. Cool. All righty. Abdul has asked, what's the difference between a chartered accountant and a normal accountant. It's basically 3 years of study and experience on top of a bachelor degree. That is the the difference. Paul, thank you for that. You did have an earlier question though. In the future, I heard the personal income tax rate will reduce for most people to be around 30%. Yes, we've been signalled that by in previous budget releases. But that, again, we still have that high marginal tax rate. I think it's still above the $180,000 of income or more. You still pay probably 47% or similar. But the 30% tax rate will be a lot larger. The band will be, from memory, from about 45 grand to maybe 180K or 120K. Anyway, it is a larger band, which should be similar to a company tax rate. Considering the admin fee and I guess accounting fees of running a company, how much profit is worth to set up a company structure as a bucket company? So basically, when is it worth having a bucket company? Again, this really comes down to the family situation, and like if it's just you, and let's say 120 grand is where, because $120,000 right now is where the tax rate goes from 34.5% to 39% tax. So at that stage, it's already better off to go to a company. But again, if we can spread income between you, your spouse, if you've got a couple of adult children, we can give some money to, then the cost benefit of a bucket company might only come into play at $300,000, $400,000, $500,000 in profit. So again, it just comes down to your personal situation. Cool. Michael's asked, can we buy a property under my name funded by the bucket company and able to be in a secured 25-year loan with the company? Absolutely. So that is this one down here, the fourth one here, secure loan as a deposit. So your 20% plus costs comes from your bucket company for an investment property purchase or even your own home. And then the 80% comes from the bank. Again, there's requirements to meet Division 7A requirements there. So it's not as easy as that, but that's the idea, that you borrow the deposit from your company, the rest from a bank. There's just maximums. Thanks, Leanne. Thanks, Elisa and Mark. Awesome. All right. Well, yeah, it's been a bit quicker than the hour. Again, we've spent this topic just on Division 7A. And as a reminder, we've got a webinar later this month coming up on the basics of business structures. So we will cover sole trader, company, trust information, a little bit on asset protection in that one as well. In October, we've got two scheduled in there, Wealth for Life, which is a 3-hour workshop. We run through a workbook together, and the focus there is on personal finances and things you can do to help build your family's wealth. And then later in October is our first of a series of becoming an SMSF millionaire. So again, that's the sort of broad overarching strategy on why an SMSF, what you can do with it, the basic ins and outs. And then we'll take over the coming months after that, we'll go in a deep dive like we have in Division 7A here, but we'll deep dive in different sections in self-managed super. Again, all those links are in the chat box. And cool. Thanks, Liz. Thanks, Abdul. Vic, what happens if my company owes me money? Company owes me money. So that's the other way around, not you owing it money. Now, if the company owes you money, you have 0 Division 7A issues. So you can take money out of your company and not have, like, it's repaying you back. You don't need to repay it back. So that's the great thing if you are in that position. Now, where that is common or, oh, hang on. Okay, sorry, you didn't mean that. Okay, sorry, mate. So if my company owes me money, so the other way around, and it was done on May 2015. So we want to make sure that you've actually made the minimum repayments. Otherwise, there is potential consequences for you to be taxed on the full loan amount, which is extremely undesirable. So Vic, that probably needs to be checked on. Again, suggestion there is we can do a look under the hood with you to work out what your options are. or if you've got an accountant that can help you with that, then definitely have that conversation. Yeah, Vic, it's not good when these are unchecked. Susan, what's the minimum income for an SMSF? That will be answered in that SMSF Millionaire course. It's not as simple as just one single figure. It's kind of like when do I need to set up a company or a bucket company? It depends. Liz, yeah, I'll see you on Wealth for Life. Cool. Awesome. Alrighty. Well,